You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, our Index Universal Life Product Exposé, featuring Athena Indexed Universal Life Insurance with Matt Berman, Vice President, Sales and National Accounts with AXA Distributors.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant. We're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me, day two, Matt Berman. Hey, Matt.
Great to be here.
Glad that you're here. And we're talking all this week about Index Universal Life, a product expose. I had to pick somebody's product to do this expose. Hey, we picked yours. I'm glad you're here. We're going to talk today about something that everybody always asks me, and this is a heavy trafficked email from consumers. So I just want to make sure that you hear this, because this is an area that you need to mitigate and manage way up front in the sale.
Yep.
The issue is product suitability. Now, there are there's four different universal life contracts. I'm not going to really address the guaranteed UL. That's pretty much term insurance on steroids,
Sure.
kind of a longer, kind of extended permanent fashion, very little cash value on most contracts. But what we are talking about today is current assumption UL. Is that the play? Index, is that the play? Or variable, is that the play?
Sure.
Product suitability is a huge issue. And when I look at the issue of risk tolerance, that leads the way, and you have to talk about it. So let's just talk about it for a moment, just to set the stage. When I'm speaking to a customer, a consumer, I want to bring up risk tolerance. And by the way, there's several out on the web. And if you say, Steve, I don't have a risk tolerance test to do, I have it. If you want to write me at thebiz@brokersalliance.com, it's a great piece, and it'll walk you through some basic ideas and actually lead your client to their own psychological makeup, which they rarely know. So let's talk about first risk tolerance.
Sure. Well, I think risk tolerance is a function of need. And it's really important to diagnose what that need is. And then it's very easy to get a sense of what the risk tolerance is all about. And in your approach, you can then look at a spectrum of products that aligns best with the risk tolerance that's out there. So typically you would have term, which is a very cost-effective death benefit play, where you have a very, very conservative posture on taking risk. And the other end of the spectrum, you have a variable universal life policy, where you would have more moderate to an aggressive approach to taking risk.
Well, when I think about it, when I'm talking to a client and I'm looking for coverage, and this is probably the biggest issue that we run up as planners, is this a coverage issue or is this an income issue? Because it really will set the stage on where I'm going to go. Is it more effective to use a VUL, a variable universal life contract, in an indemnification versus an income? And remember, you have to go through the complete inventory of most of the carriers that play in this space and to measure, is that a good deal? But every time I get past that basic threshold and I say, by the way, the illustration I showed you is only based on whatever we're displaying or inputting in. Could you lose your money? And when I say yes, I want to see how old the client is, what's the propensity for risk, can they handle a downside, how did they handle, I always like to say, how did you handle your 401k drop in 2001, 2002, 2003, and 2008? I want to go through a gauntlet to make sure I ferreted out the actual psychological profile of my client to make sure, am I going current assumption UL, index UL, or variable?
Sure. And I think that looking at that spectrum of needs and then applying the right approach and then the right product to really fulfill that sales strategy, AXA is positioned well to accommodate all of those approaches which are out there. So as I mentioned, you have a term play, which is a very basic death benefit focus. But you raise a very good question. You know, if death benefit is truly the motivation, what is the best product that's out there? Are you getting a more cost-effective pickup on term versus some of the other permanent products? Because the other permanent products out there and the other permanent products that we have in our portfolio can't accommodate death benefit plays. But it really comes to risk tolerance and what that upside and what that downside could be in any of those cases. So looking even at the far end of our spectrum, where we talked about moderate to aggressive risk tolerance in VUL, AXA Equitable has a variable universal life policy that is specific to death benefit plays, IL legacy. It can give really cost-effective coverage and some upside protection because you are participating in the market. But again, looking at the need that's out there, the risk tolerance of that prospective policyholder, and then evaluating the upside, downside, and the expenses assigned to each of those policies, you really have to start to get into the weeds and find the best application.
I always wonder, are advisors actually looking, as you say, in the weeds, and really looking and measuring side by side, kind of a tale of two cities, IUL or VUL? For this case, indemnification or income? I have to look at that and then look at the risk tolerance. I mean, I think people are not managing this. They need to manage it a little tighter.
Yeah.
Product suitability is a huge issue, and we ought to make sure we're always giving the client what really fits. And I guess that's the last thing, I'll let you go before the break. Fit. That's the issue. Does it fit the client?
Yep.
Talk a little bit about that.
I think that it's a great question. I'm glad we're finishing off on this topic, because fit is, I think, the final question when you're evaluating the best product for the need that's out there. And there are nuances and features and benefits in each of the product that will ultimately define that. Having death benefit protection with upside potential is a great play. You could go variable universal life, or you could go index universal life. But in the detail of those products, you have downside protection in one, and you don't have a floor in another. So fit is ultimately the goal, but you really have to get into the product structure, and is it really aligning to the need of the prospective policyholder?
I think if we would do this, so two things would happen. I've noticed that when we use product suitability at the front end of a sale, we have really set the groundwork, the fundamentals, not only for our own practice, if we do it all the time with all our consumers, but we can get what I call policyholder expectations, good experiences that they will always come back to, and that's where referrals live. When we come back from the break, we're going to continue our expose on Athena Index Universal Life product and its application in your practice. Don't forget to enroll in our IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Welcome to the Brokers Alliance Auction House. I'm Jessica Lopez, and that's Steve Savant. What are you doing?
I'm practicing my auctioneer skills for our carrier bidding process for our producers' substandard cases.
Steve means that we're packaging our substandard cases for underwriters with specific carriers that are known to specialize in certain health impairments.
There are really only a handful of competitive carriers in each category, and we've identified who they are.
It's all about securing the best possible underwriting offer by packaging your substandard case with the right carriers.
So let the bidding begin. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Matt Berman. And remember, you can order today's giveaways at thebiz@brokersalliance.com. And when you're looking at those orders, I want you to order dollar cost averaging. It's a great piece, a great document, and it really walks you through people who want to pay monthly. And I mean, there's a lot of people out there. Not everybody can throw an annual premium. Yep. Dollar cost averaging is a great way to play in indexing. I really love it. Also, we're going to be giving away our product suitability. You can kind of walk through this yourself. It's got great questions. You can walk through it and help you evaluate the needs, uncover needs, and it's really a good piece. It really gets you in the practice of asking the right questions so that you're always presenting the best possible scenario for your consumer or your client. And remember, just a heads up, before moving forward with any of the ideas on the show, always consult your tax advisor and broker-dealer compliance department. In this segment, we're talking more on the Athena Index Universal Life product and its application in your practice. And when I'm looking at the yin and the yang, let's just say we've eliminated in our discussion for today, we're okay about current company assumption UL. Sure. We're not going to deal with that anymore. But let's talk about basic side-by-side thinking. Now, in indexing, the big claim to fame is I cannot lose any account. Now, I just want to say we'll get in, except for I do have expenses to pay. So I don't want to get into this, hey, I lose nothing. I want to talk about performance. And so I like the idea. Think about this. If you had an index contract during 2001, 2002, 2003, 3 straight years in a row, the only compounded loss you would have experienced would have been whatever the expenses in the policy were.
Correct.
So when you look at the average policies back in the day, that was about 230 to 240 basis points on average.
Sure.
And I think when you look at that number, that is the worst scenario. See, so I kind of like looking at that. Now, if I took the same time zone and I said, let's apply VUL to that, it would be a lot more than 240 basis points.
Correct.
So talk a little bit about when we're talking about risk, because some people say, if I'm doing an insurance product, if I am doing an insurance product, why am I using a variable contract? Because it has risk in itself.
Sure.
So talk a little bit about that philosophically.
I think that a variable contract offers a unique approach. And again, based upon the need and the risk appetite, a variable universal life contract can give you full equity participation and allows you to really diversify your investments to manage coverage expectations as well as maybe any supplemental income needs you have down the road. And interestingly, what AXA Equitable did a few years ago, facing the credit crunch and looking at our portfolio of variable universal life contracts and looking at prospective sales, we felt that we had to do something a little bit different with the product. And recently we introduced what we call the market stabilizer in our contract. And essentially what it offers is an index sleeve in a variable universal life chassis. So for individuals that intuitively understand that equities provide long-term value, but recognizing the recent past and some of the hits we've taken in the markets, this allows you to ease in or ease out of that equity participation.
Well, now I'm curious because now that you're using an index, using some technology from indexing,
Correct.
and you're applying it over to VUL. Talk a little bit, because I had not thought about this in in those terms.
Sure.
What does that do for my policyholder?
Well, what it does is a couple things. I think it allows you to diversify your investments a little bit more. It gives you some optionality if you have any reservations about short-term growth, or perhaps you've had your money in the market for quite some time and you want to wean down your investment and you want more protection.
If I move that over to the index sleeve, as you say,
Sure.
I love your nomenclature, man. It's just great. Your semantics. If I put it in there now, does that act like an index now? Could I still lose in that account or no?
Great question. It behaves in a very similar context to a traditional index universal life policy. However, the major difference is you don't have full downside protection. We cover in that particular sleeve the first 25% of loss in any annual segment. So in an environment facing 2008 where we lost, let's say, over 25% in the market,
Yeah.
your loss is, you are only responsible as a policy owner for the difference between the 25% and whatever the market lost. So let's say 28% loss, you're responsible for 3%. And that's a huge risk mitigation factor. Now the other benefit, it is adding potentially more upside on your cap. And the reason for that is based in the hedging. So we look at that sleeve as any other index universal life contract, and there is hedging that goes behind it, and we purchase options to make sure that we can capture that behavior. So the hedging is a little bit different, and what that allows us to do is to purchase more on the upside. So there's an interesting quid pro quo. You're responsible for the first 25% of loss, but the upside is you get a little bit more on the cap in certain years based upon interest rates and volatility. So it's a little bit different, and it changes the conversation on VUL a bit.
I think it does. In fact, actually, it's actually almost a hybrid when I think about it like that. You have two options on this, on a VUL that I don't know of anybody else that has this. I'll have to check my inventory. That's a huge, unique aspect of the VUL. Now, for people though who say, oh, I just can't still, you said 25%, thank you for that, but I can't stomach it. So I want to go back to my indexing, and when I look at indexing over the years, I'm looking at 20-year, 30-year lookbacks. How do you guys calculate your indexing, especially when you want to do illustration? I noticed that you already give, for every index, you give illustration examples.
Yep. You know, like other carriers, we have a look-back period and we manufacture an illustrated rate based upon those parameters. But we always advise with our intermediaries and our producers, you got to run the sensitivities. When you look at our product and you look at other products, sure, you have an illustrated rate, but that's no guarantee on future performance, and you got to run the numbers down a little bit to see how that policy performs when it's stress test. So,
well, when we come back, we're going to talk more with Matt about a theme. And you know what I really like about this? It's really important to know that when we're talking about index and VUL, that I have a carrier that's on both sides of this fence, and we'll let the client make the call.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.